Stocks responded to the FOMC meeting today and interest rate decision with a bang, breaking up to new all-time highs, continuing some very strong moves that we had seen previously, and for the Russell 2000, continuing what was a little bit of a breakout move and really extending and confirming a breakout move today. So we're going to take a look at the different indicators right now and what they're saying in terms of this bullishness, how strong it is, what we can expect to see. When was the last time we've seen something this bullish across all these different indicators? What happened from that point going forward? So we'll break that down as we always like to do, kind of looking for past precedents. So we can look for similar situations to occur. We'll take a look at what's driving the price action today. What's going on with the dollar, what's going on with bonds, what's going on with commodities. All these different asset classes are having some pretty interesting moves right now. We'll tie that into what's occurring with stocks. And then we'll take a look at a stock itself that is kind of breaking out to a new bullish intermediate run itself. A little bit lagging behind the market from a timing standpoint, but can it then now mimic what the market has done going forward from here? And we'll talk about how to trade that with that in mind. So let's go ahead and get started. Today is Wednesday, November the 3rd, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. You can see the rally. Look, we are in the 90th percentile now in the past year in terms of being above the moving average. Over 4%, over 4.25%, over 4.33% above the moving average. Again, one of the highest levels we've been at this past year. Obviously, there's been other. If you go to the 5-year chart, we haven't been, especially coming off that COVID low point. That's when we were the highest. We hit those high levels. But needless to say, if you were to change this little dotted line here, take those out of it, obviously anomalous because we were coming off such a significant low point there. But if you look at all these other periods of time, this is a pretty decent level for strength coming off of a little bit of a low point itself that we've had over the last little bit right here. So the intermediate line got up to about as high as it could possibly get to, the 99th percentile practically. Just 900ths of a point off the 99th percentile. The near-term line is above 90 for the fourth straight day. Remember, we just barely had a 5-day, I think 1, 2, 3, 4, 5 days a couple weeks ago. Kind of straddling post expiration, straddling that expiration, and then now we're having another, pretty much 5-day streak, but pretty much a 4-day streak because you got down there on the 29th. That would have been last week. So it been Friday of last week. We gapped down and then we rallied up through. So that brought the near-term line back up above 90. We've been up now 14 days of the past 16. So we've almost had 3 full weeks of every single day going to the upside. That very, very significant. Our 2 down days was this last Wednesday, a week ago, as well as the Friday before that, just a small smidgen of a drop the Friday before that. That brought the near-term line down below 50, but not into bearish territory. So technically, this is still all one big near-term rally that we're on right now. The blue line would be our current intermediate rally. So there's been 2. This first near-term rally started it, and then now the second one is really getting us to getting the intermediate line into bullish territory. Not just in the bullish territory, but well in the bullish territory. Surprising we haven't got a cluster yet. Remember, the NASDAQ did get a cluster over here a few days ago, a couple days ago. Let's go back to a 1-year chart. So there's the cluster, and again, we are 6% above the moving average on the NASDAQ, which is, again, the 95th percentile for the past year. So very, very strong move right now going on in equities, needless to say. Kind of the understatement of the year. If you take a look at the Russell 2000, that one's really great. I mean, today, of all days, like these last 2 days, we're kind of like, we're kind of right around the all-time high. And kind of yesterday, I think we actually did get an all-time high, but I mean, it's a very small range. And, today is more of a breakout than what we've seen. It's a very, very strong move. Your near-term line now has been above the 90th percentile for 3 days in a row, and practically the 95th percentile for 3 days in a row. We are nearly 6% off the moving average. We were so strong over here coming off of that level. That was such a strong move to the upside that it kind of puts any other move since in it's not nearly as strong. If I were to take that out, then you can see now we're a little bit higher. We're in the 81st percentile. And of course, I still got a strong move that before we peaked there. So if I were to go 6 months out, now we are in the 100th percentile. Now this is the highest level. We've been above the moving average for the past 6 weeks. So needless to say, it's a very strong move we're getting all across the board, right? All across the board. Finally, your Dow Jones Industrial Average, your near-term line finally getting above 90 again, too. But you see the near-term line, that drop did get us to, we had crossed below 3 lows, closed below 3 lows, the prior 3 lows. So we did get the near-term line dropping in the bearish territory there, just not on the S&P. The Russell 2000 also did get on that same drop. In fact, they got the momentum line down to extreme lows. Near-term line got into the reversal zone, but it's your NASDAQ that's been, it on that little drop there, the near-term line barely got below 60. So obviously still one big long intermediate or near-term rally that tends to last 7 to 12 days. And of course, we're on like day 15, 16 of that near-term rally right now. Let's take a look at some of these other oscillators and see how bullish they are here really quickly. For the S&P, look at that, 73rd percentile on RSI. We got up there going into April expiration. We were about at these levels, 74th, 75th percentile. And you can see we were pretty sideways for the next expiration cycle, or two actually. From May expiration to June expiration, we stayed flat before rallying back up. Again, getting back above 70 also made us flat for about another expiration cycle. Ups and downs, obviously, in between, but by the end result, pretty sideways. So it's a very high RSI, and your CCI is diverging. So we're not quite back above 150. 150 is kind of a limit. Here, let me show you. The 150 mark. It's a kind of a bullish level to achieve and to exceed. Obviously, getting above 200 is very significant, but you can see outside of those spikes above 200, 150 tends to be kind of a limiting factor. And you notice that the CCI getting above 200 there would be a lower high point with an obvious higher high that we have going on. So we need to kind of keep our eyes on that divergent opportunity. Look at the ADX high, relatively high. Again, we haven't seen that since that April expiration again. It's about the last time we got the positive index indicator as high as we are now. And also the last time we had the negative indicator about as low as we have it now. So keep that in mind. The ADX eventually peaked a little bit later as we were declining, because that ADX is a lagging indicator. But it's a very strong, we're very wide gap here between the positive and negative indicators. Like again, we haven't seen for quite a while here. Ichimoku trend cloud, we are above 80, almost above 5, so we are up to a mature trend. Again, anything above 65 and 2 gets us started on the trend. 50 and 80, or 5 and 80, now we're on a very mature trend that's hard to reverse, right? It's kind of, you have to, look how far we have to go just to get below the blue line. So it gets really hard to reverse those kind of patterns. Look how far the red line would have to go to drop back below price. So it's, we are an established trend that won't just change on a dime. If you look at small cap stocks, not quite the same, but still pretty darn high and well up above. And we are above 80 on the trend noise balance, which we just haven't been. We never did get above 80 on this drop. So we haven't been above 80 on the trend noise balance in quite some time here. This is the 65 level. We haven't been above 2 this entire time. And now we're finally above 2 and almost above 5. And again, last time we got above 80 and 5, we had a really good long trend that came out of that. If you take a look at the 2 line, let's go look at the long-term chart, this long-term chart here for the S&P. Good, strong candle. Again, look, we're closing above last week's high point. We did that last week. Those are the kind of candles that are really good, right? We are finally doing that on the Russell. This is we're not only we're closing above last week's high, we're going to be closing above a bunch of weeks' highs. Very, very strong with the PPO starting to rise up again. Now, granted, it's already at 4.5%. The S&P is already at 6%. So it's not like we're coming off of zero on either of these indexes. So keep that in mind in terms of how much energy we have to the upside from here. In fact, when you look at the market forecast chart and you look at this last kind of breakout move that we had back over here, the market sentiment line was right around 60. This one we were actually a little bit lower, but not in the bearish territory like we were obviously in the COVID low point when we had that strong rally. But again, that's a strong, very similar move right now that we're getting coming out of the election last November in the small cap index. Let's take a look at the 3 green arrow chart. 3 green arrows. The MACD had been dropping, but you see green bars, which means the MACD is turned back up again on all of these indicators. So just kind of watch to see. Remember, it's not like we're going to get another big hump. That's not how this works. The initial surge occurs when you're breaking moving averages, and then once you're well above moving averages, our momentum really tapers off. So you expect that we won't get very many green bars here. The question is we're not. If you look at the 2-line versions, we still haven't started to converge yet. So the MACD histogram peaks first, the MACD itself peaks next, and then that's when you start your bullish convergence, where the MACD drops below its moving average and heads towards zero. But while you're converging, you typically stay above the 17-day moving averages. We just go at a much slower pace than what we did previously. So again, very similar to April expiration, where we went sideways for 2 months as we had bullish convergence, and then a slow grinding bounce up that also converged briefly and ended up pretty flat for 2 expiration cycles. So something to keep an eye on there in terms of how this convergence ultimately plays out, because it's a pretty high, pretty high MACD average. Obviously, that's on an absolute level. So let me take a look at it here on a normalized basis. The 817 you can see here. Let me get rid of for a second the stochastics and the MACD. There we go. So here's where we're at right now. We are in the 83rd percentile, kind of right where my cursor is, following that left. So you can see about as high as we are when we got back there. We got up to 1.38 at the peak, and right now we're at 1.16, which is higher than any of these other bullish moves, and for that matter higher than these bullish moves that we had as well. Only that first initial surge got us up to 1.56 post November election, and then that surge coming out of this March low point that was actually an intermediate pullback for the NASDAQ. That was a strong move, and now again coming off an actual intermediate pullback for all the indexes here with this current move with low volume. You notice below average on the volume. In fact, when you take a look at today's volume and trading range, the trading range was above the average 4 points, but the volume was down at 51 million. So looking at putting those numbers in context here, so 4 points is above this number, and it's below 1%. 1% would be 4.64 points. So anything above that obviously would be bearish. Anything above 59 million is bearish. So we're getting pretty decent bullish numbers that would allow these to keep falling, except for just slight. So don't expect that we'll stay up there. If we do stay up there, then that means we're bearish. All right. So you can see our implied volatility percentile is really, really low right now, down in the 7th percentile. In fact, when you look at the daily price moves here, the S&P, there's the historical volatility right now, way down to extreme lows already. That's not necessarily the case for IWM because it's been rising. We look at these big 3 strong moves that we've had. That's actually made volatility implied and the historical volatility rally. If you take a look at, go back to the ATR here and look at IWM, again, you can see we kind of based, and we've been getting bigger moves. And ATR is rising, volume is rising, so that's got to obviously taper off once we do get through these highs. The problem is they're already relatively low. There's not a whole lot of tapering left to go. There's some. Obviously, we're not as high, not low as we were going into COVID, but we are about as low as we've been since COVID on this. Looking at today's volatility is kind of interesting too. We did drop back down to 15, and we dropped to extreme lows. Like we are down to the 78% of VXV. So the VIX is at an extreme low point. We got to this level before. We got to 77%. So we're at 78 right now. That typically is bullish. It's an extreme low. Volatility doesn't stay extreme lows for very long before bouncing, and it also limits the opportunity for it to break 15, which would be a significant break for the VIX, and kind of signal a new regime of lower volatility. So we'll see if we instead get a move back up towards 20, if we get an oversold, extremely oversold technical bounce on volatility there. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked our video today and you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. If you don't like our videos, of course, you don't even have to watch. You don't have to click on anything. You don't have to watch, right? Also, comment down there. What did you get out of the video today? What stood out to you? What questions or comments do you have? Post those down below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right-hand column to the right of the video. Click on this icon. That takes you to our Market Outlook live page. This is where I review all the trades that we're still in from previous Market Outlook videos. We also, to see whether we should stay in them or get out of them. We talk about why and how. And we also put on today's trade idea already before the market closed earlier today. So you're going to see at the end of the video. We've already placed that trade today. We did it here. Again, it occurs at 3:30 Eastern Time on this page on our website, Monday, Wednesdays, and Fridays. This is a very easy way. You can also get to it up here under Market Outlook Live Trade Review. Here's our upcoming classes we have. If you click on this View More, or you can click on Trading Rooms, it takes you to our calendar with all of our upcoming classes as well as all of our recorded sessions. You can see today's classes already recorded there. And then finally, come down here, to the bottom, click on that heart. It opens up this new tab. Hit that like button. Also click on this thumbs up icon. Opens up a different new tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers because of all the engagements it has. So you can see not as many engagements, so not as many people. Out of 1,000+ people that follow this Facebook page saw this post because, again, that's how their algorithms work. It also benefits you to engage with us because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here while you're watching the video right now. All right, now let's take a look at our at this price action that we have going on. You can see there's the gain. There's the 14 out of 16 days. There's the 2 down days, 1 down day there, 1 down day there. Every other day has been to the upside since the 13th, which happened to be the day that we left on my vacation here. So if I were to go out here to October the 13th, that first update, which wasn't very much of an update, but it was an update nonetheless. You can see here we gapped down, we finished the day higher, and then we were up ever since. We're currently up 7 to 8%. The Qs are up over 10% in this 16-day window that we're up 14 out of the 16 days. On the other side of the equation, you can see real estate's also very strong, up 6% practically. Bonds are up, gold is up. Really, the only thing that's down is the dollar, and then you can see now commodity prices, which started off relatively strong during this rally, had kind of peaked and went sideways, and then since this last little surge, and the Qs especially, but also in IWM, commodities have just fallen off to the point where they are now negative. let's take a look at that crude oil. Crude oil is a big function of that. Let's take a look at that chart, the market forecast for crude oil. You can see we've been on a little bit of a decline, and today even more so. Today we're closing below a bunch of lows. Now we are above the 30-day moving average still, so we're still like got the green line, but we broke below the 8 and the 17 today. So very important that we hold that, because we are definitely in a bullish divergence right now. Breaking below the 17, we already were in a bullish divergence, but today's the first day we broke that 17-day moving average. Obviously, there's a lot of support below you, lots of volume down here below the 50-day moving average, so you wouldn't expect, you know, a tremendous drop, maybe a little bit below the 50-day moving average like we saw over here at July expiration before bouncing, but still, that's one of your more bearish near-term declines. Obviously, we are at the moving average, so you know we're very small positive number, and now we've got more of a bearish near-term line that we've seen since we've rallied on this level. In fact, you know, we've kind of had some ups and downs right there, but we were on pretty much one big long near-term rally with a couple overbought clusters inside of that near-term rally, and then now getting a kind of a bearish, relatively bearish near-term high, because we never did get above 80. And back into a stronger bearish territory than what we've seen. So a little bit of a drop in crude oil and in commodities in general. This would include like other commodities too besides crude oil, gold to some certain extent. Obviously the big mover today was bonds. Look at the big drop in bonds, a big engulfing pattern as well. The intermediate line had not gotten into bullish territory, is now already rolling over. The near term line, which got pretty strongly bullish there, wasn't able to follow through on that, so you can see some kind of pattern, candlestick pattern would be a bearish reversal candlestick pattern there. We're not quite too strongly bearish on the near term line, but the momentum line definitely got to an extreme low. So it appears that your 10-year note is really going to start to ramp back up again as we come off of this with its own engulfing pattern, and then you're coming off of this near term low, pretty strong near term low that it had. Of course, that's all about inflationary expectations, and it's all about the inflation odds, the odds that we'll get a rate hike. If you go out to this June meeting, I tweeted this out here earlier this afternoon, at the June meeting, so that the Fed, if it keeps its current pace, is expected to end its tapering by June at this $15 billion month. So it'd be done by June, which would mean right now the Fed has got a 65, or the Fed Fund futures market is giving you a 65% odds that we'll get our first rate hike in June. So if you recall, Powell today said there's no chance, like we are not even considering a rate hike right now. So we didn't even discuss it. They asked him about it in the press conference and said we didn't even think about or discuss it. But just remember that the Fed never hikes rates when they want to. They always hike when the market pushes them into it. And right now the market is pushing them, the Fed Funds futures market is pushing them towards a rate hike in June. Obviously not based on what they're saying, but based on what the market is doing. There's demand. Obviously the 2-year note still is ramping up. Here is at 50 basis points. I remember the current Fed funds rate is at 0 to 25 basis points. So you can see it kind of sticks in the middle, the 2-year note, when you're in 0% interest rate mode. Obviously they started to ramp up, but still kind of at the high end here in July, August, September. But you can see since September we've really broken out to where the market is pushing the Fed towards a rate hike. I mean, we are at 50 basis points in the 2-year note, well above the 0 to 25% rate, which is back over here where the Fed funds currently is. So so if you look now and say, okay, well, that's when the first rate hike is. When would be their next rate hike? You can see by the end of September we have a 97% rate chance for a rate hike, or 94, excuse me, for a rate hike, for one rate hike by the end of December. You can see there is the inverse of that, so it'd be about 70% chance of a rate hike, of a second rate hike by the end of December. And then when you add these 30 to that 60, you got about a 40% chance now of a of a third rate hike by the end. And you can see that number has been ramping up from a month ago, that 21%, a week ago at 32, and now we're at 34. That number, even for a fourth rate hike at 25 basis points. It's a pretty strong number, and that's much higher. It's down a little bit from where it was, but it's much higher than where it was a month ago. So a month ago, we were only at a 70% chance of a rate hike, but then the 2-year note ramped up, and the market's saying, okay, now we have a 94% chance. Remember, and most of the Fed, most of their expectations, we'll get new expectations in December, but out of the, whatever many participants there are, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. You have 1, 2, 3, 4, 5, 6, 7. So 11 out of the 18 FOMC participants expect no rate hikes through 2022. 16 of the 18 only expect one, and the market is pricing in at least two. You've only got 2 participants right now with the expectations of 2 rate hikes, 2 out of the 18. So the market is definitely pushing the Fed, and we'll see how that changes at the next meeting. But it appears like the market is pushing the Fed towards rate hikes, and that's going to be bullish for TNX. And on a relative basis, you would expect that to be not so bullish for the Qs, on a relative basis relative to IWM. You can see it kind of rallied at the end of the day and finished above the 30-day moving average, but you can see the decline that it's on right now. The MACD is rolling over. The PPO is rolled back down and gone negative again. The CCI is back below 0 and dropping. The RSI is back below 50 and dropping. We have a bearish cross on the DMI, so we'll see if this turns into more bearishness. You can see we're pretty bullish for a while. We might turn bearish here for a while on the Qs. And remember, from September to the beginning of October, when we had that drop there, that wasn't bullish for markets. When we ultimately peak here, we peaked up roughly right around September the 14th is when we had the highest close on this relative strength. And we had the lowest low on the 4th. So from the 14th to the 4th, kind of give you an idea of what that looks like here from September the 14th. So it would be September the 15th to October the 4th. To October the 4th. So here's the underperformance in the Qs IWM, and you can see it was a bearish period for equities just in general. IWM was able to maintain, and you can see the bond yields were rallying sharply. Bond prices were down 4%. The dollar was up 1%. The commodities were taken. I mean, this is a very inflationary trade there. So with that, let's take a look at the dollar now and see how it's responded to the Fed's decision. You can see we were relatively bullish. We're still in a golden cross environment for the dollar, and we're still above the 50-day moving average. But it was a pretty decent drop today for UUP, a little bit of an engulfing pattern there. And dropping back below the 8 and 17-day moving averages, which are still currently below the 30. So we had been on the kind of a pullback down to the 50. We had been kind of bouncing, but not really, not enough to get the 8 and 17 up above the 30 yet. And we'll see if we make another run. Now, remember, below the 50, and one of the reasons why we stopped there is there's some very, very strong support for the dollar. In this area at 25 on UUP on this ETF. This is the ETF that tracks the dollar futures index. So again, it's we're kind of doing a derivative of the derivative here, but that's kind of one way that we can kind of keep track of how the dollar responds. Again, if yields rise and the dollar rises more, we get that same kind of inflationary move, and commodities themselves bounce off this 30-day moving average and make another run, kind of like we did here, September 15th, all the way up to October the 4th, make that strong rally to the upside. Then we've been flat since then on commodities. Then you would expect this kind of a similar result, and which would be negative for the Qs, which had gotten to overbought cluster, right? And we've pretty strong in the MACD, and we're pretty, we've got a parabolic move here going, so it'd be negative for the Qs. and that was more bearish for the broader market as a whole as we kind of rallied towards that low point right there and then bounced off of that. So before we look at our trade idea, really one quick look here at the sector charts and how they performed here today, and really how they performed since, again, that same October the 13th low point. So it's right here, and we'll do sector comparison. So same time frame of October the 13th on to now. You can see it's been XLY is up 13%. This is an ETF, mind you, with a bunch of constituents. But look at what's really driving XLY. When I look at this chart, this relative strength chart, let's look at the XLY members and look at them on a daily basis here. This is what's driving. Again, we're going to relate this to VTI, the U.S. stock market, total stock market index. Look at what's driving up here to the upside. I mean, you've got all these kind of stay-at-home trades that are all in the red. They're all starting to turn up to the upside. You got a lot of things kind of moving down, but look at what your biggest mover is. The one that's really driving this is Tesla, way up there to the right. It is what's driving most of this price action. If you do the same thing with XLK, because that's the other big mover, right? The other big mover has been XLK here, up almost 9% during that same time frame. So let's go to here. Where to go? Let's actually go here, and let's actually do this. Let's go back to a daily chart. Let's do VTI, and let's go back the 16 days, right? This is the 16 days that we've been so bullish. There's been your big movers relative to U.S. equities to the upside. You know, there's Nvidia. You can see a bunch in the green here. There's Apple. You can see where Apple's kind of turning down. And look at everything else that's moving down to the right. Visa and MasterCard, all your payment option services all moving down to the left, really sharply down to the left. There's Cisco and Qualcomm, a couple big tech names. Qualcomm having a big move higher. There's Microsoft and Adobe. You can see kind of what it's doing there. So really, you kind of, you've got your chip semiconductors, Xilinx, AMD, Teradyne, and Nvidia all moving up to the right. A very, very strong move. And some of these others, Micron and Lam Research and Microchip, also moving up to the right in the semiconductors area, Skyworks Solutions. So semiconductors right now, outside of Intel, is your big movers that are moving that XLK. So you've got semiconductors, you've got Tesla. Come back over here, and for a while there you had energy, but look at energy is, in financials and industrials, they're all lagging. That's with Russell 2000 is really kicking butt. You'd expect these areas to kick butt too, and XLC is a big component of the Qs because of all those social media names. They're all really lagging behind. In fact, lagging behind utilities and staples, which is kind of rare. And then, so again, it's a very small segments of the markets but they're really pushing us up right now. And as I tweeted out yesterday too, a lot of the Russell's gains the past few days have come from those meme stocks, and whether it's Avis, whether it's AMC or GameStop, those kinds of stocks have really been rallying, and there's such a large percentage of market cap weighting of IWM because they're so much bigger and there's so much volume associated with them the last few days that they've really kind of been the impetus behind the Russell 2000. So unless we can get more of these areas to really follow suit, then we can say, okay, if we can get a broad rally to break us through, go back to the Russell, to break us through here, great, I feel really good about that breakout. But if we don't, and if we come back below 2350 tomorrow by the end of the week, and we do get that long upper shadow there, then that's going to be about as bearish as it can be. So very good breakout today. It's not fueled by the best kind of breadth, but we take what we get. And if it holds, great, then we'll feel better about it. So we got another couple of days here by the end of the week. We'll have a better picture of the likelihood that this breakout and this bullishness that's pretty extreme on the other indexes will hold, or whether they'll already start to consolidate and maybe even start to kind of buy the rumor, sell the news coming out of this expected tapering announcement that everybody's been anticipating, this relatively dovish tapering announcement that the market finally got delivered to it and has been anticipating going into today. All right, now let's take a look at our trade idea of the day. And so what I wanted to look at here was Cisco. Let's take a look at Cisco here. You can see it's got its own little kind of breakout pattern going. Yesterday got a really good bullish move to the upside and held it so far today. We are down just a smidgen in the after hours. Qualcomm came out with some earnings. So we don't quite have the earnings yet for Cisco, but they are coming up. Good bullish move, almost to the 90th percentile on the near-term line. You can see the intermediate lines getting up above the 80th percentile here pretty soon. So we have the new intermediate trend going, and that's kind of confirmed by a bunch of other indicators too. We're above 60, we're above 200 on the RSI and the CCI. When you look at the DMI, we got above 30 yesterday. We're below 20. We're still right around 30 and 20 there. So a good breakout pattern on that chart. We've got above the Ichimoku cloud today. We got above 2 and 65 on the trend quality indicators down there at the bottom. We broke up above the upper band, Bollinger Band, yesterday, and kind of broke above this volume node as well. So that's a good sign for the markets. In fact, if you look at the Keltner channel, we also came really darn close to breaking above the Keltner channel. And now your Bollinger Bands are pretty close to themselves breaking out of the Keltner channel. Some strong momentum here. So good patterns for Cisco across a lot of these charts. You can see the bullish candle that we're getting. And if we continue into the end of the week, we're that close to closing above the high point there. We're about 0.02 of a point right now above that high point. So a good new bullish trend developing on the Hakinyashi candles. The 3 green arrows, let's take a look at this chart here. The 3 green arrows, you can see we broke above the 50-day moving average. We had been holding the 50-day. We broke clearly above the 50-day. And now the 8 and 17-day are diverging away from the 30 themselves, pretty close to breaking above the 50. So a good breakout moves across all these charts. So what we decided to do on this one, especially with earnings coming up, was to buy the at-the-money option here. And then sell the 60 option. So it reduces my risk by selling that option, reduces my costs in the trade. It also, down to this case, there's the options there. So if I were just to buy a call option, you can see with similar risk, my break even is going to be up about $59.50. But with the here, let's do hide simulations. But with the iron condor, with the long vertical spread, now my break even is only at $58.50. So got a little bit higher probability. And you can see too that if I get up to $60 at expiration, I make a $725 reward. Whereas with the long call, if I get to 60 at expiration, I only get a $131 reward. So I really get a much higher probability of, if you think about like what's my probability of a 70. Here, let's set this at $60 or higher. So if we close above $60, to get to a $720 gain at expiration, right about in that area, it's about a 21% chance of doing that with the long call option. But with the long vertical spread, I have a 31% chance. So a little bit better probability of getting that $700 reward. So higher probability, lower cost than the long call. And with the give up, what I'm giving up is the opportunity for a big breakout pattern to get a suit. But if we just get up to 63, just even getting back up to 60 would be getting back up to these old highs. So that's going to be an achievement in and of itself just to get to that point. That's why I'm a little hesitant about being too aggressively bullish on this trade. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Have a great rest of your Monday night, everybody, or Wednesday night, excuse me, and we'll see you all next time.